Hello, hi. Jerry Miller here from Trendsignal, the trader education company. Let's look at our markets for last week and what's happening this week. And I want to focus on really the start of the week, the first couple of weeks, and try to explain why the markets have gone up in such optimistic mood. And to do that, we're going to have a look at some issues, pointers that will help explain what's going on. Um, why are the markets optimistic? I mean, firstly, what I would say is that yes, they've gone up. Last week there was very much a more concerted risk-on move compared to the first week of the new year. The FTSE was up 144 points, close to record highs. The Dow up another 670, S&P up 104 points. That's all just over 2.5%. The Nasdaq nearly 5% higher, 509 points, and the DAX. A lot of European stocks, not just the FTSE, the CAC, the DAX, all doing particularly well. The DAX really just on a straight line since the beginning of the year, up 476 points last week, which is what 3.25%. And part of the reason is that I think the mood got a little bit too gloomy in the run up to the new year. Stocks typically do quite well in the new year, so that's another reason why the markets have gone up. But also, we had US inflation data out last week, and that posted for, as expected, from 7.1% in November. December's reading was 6.5%, all down to collapse in the price of gasoline and other oil products in the wake of a sharp fall in crude oil prices. Um, Nasdaq was particularly strong because it's more sensitive to interest rate rises, and there is the feeling that interest rates are likely not to move as high as some had initially thought, or not initially thought, had been speculating on just 4 weeks ago. And in fact, the Fed Watch tool, in fact, let's have just a look at that. Let's just pause this a second. So this is the Fed Watch tool. It's provided from the Chicago Mercantile Exchange, and it basically tells us what interest rates are going to be at the dates of the central bank policy meetings. That's the Federal Reserve central bank policy meetings throughout the year. The first one, well, actually the first of Feb, that's culminating on the first of Feb. It's a two-day meeting starting on the 31st of January. And as you can see, the consensus is for a target rate of 450 to 475. Currently, we're at 4.25 to 4.5. So, yep, we're predicting a quarter point rate rise. And the percentages of these near-term rate rises haven't really shifted much. There's a strong probability then in the 22nd of March meeting of another quarter point rate rise. Remember, the Fed have been very aggressive throughout the year, throughout last year, I should say, pushing up rates by 0.75% on 4 occasions. So this will be quite a change as the Fed slows down its rather aggressive rate policy. And I think it's probably as expected. I think the market expects the Fed more than the Fed is saying what they're going to do. I mean, the Fed have said that they're determined to tackle inflation. They're determined to make sure that the genie, want a better description, is put back in the bottle. And one of the problems with the markets is that they tend to be a little bit optimistic about what's going to happen. Sure, inflation has come down, as we know. It's fallen now for 6 straight months already. How time flies. We peaked at 9.1% in July, and we're now already down at 6.5%. So the moves have been quite significant. So just looking at the data that came out last week, inflation now 6.5%, was 9.1%. So that is a sharp move. But the problem for the markets is that this is what the predictions are when we look at the Fed Watch tool. This is a prediction for the meeting throughout this coming year. But a lot can change. For example, the Federal Reserve have got to wait until their preferred measure of inflation, which doesn't come out until the 27th of January, only 3 days before their meeting. And that's this thing called the PCE, or Personal Consumption Expenditure. And that will give a better insight to the Fed as to exactly what's going on. And that'll probably sway them more than the recent inflation data release. But the signs are positive. And as I say, a lot of what's been happening is really a re-rating of the markets rather than the market getting really bullish at the start of this year. So let's continue this discussion. Um, well, US inflation and market expectation for rate rises in 2023. We've just been looking at the Fed Watch tool, so we've got a pretty good grasp on that. If anything, the Fed Watch tool suggests that there is a slight possibility of rate cuts by the Federal Reserve in the final 2 months of the year in November and December. But as I said, a lot really can change from there. Inflation expectations, well, we're already down at 6.5%. The problem with what's going on in the markets is that a lot of this depends on what happens in Ukraine. And even at the time of speaking to you now on Monday morning, we hear news that Belarus and Russia have started military exercises in Belarus. That's on the northern border with Ukraine, which is really just ramping up more tensions there. And that Kiev has to prepare for a potential move. I'm sure the intel suggests that that's not going to happen, but it's just interesting that this has already started early on in the year with inclement weather unlikely to allow a meaningful invasion, but you just don't know, do you? So there's a lot of question marks that hang over the markets, and the biggest question mark is what happens with the war in Ukraine. What happens with energy prices? Does oil go back above the $100 mark? Will natural gas, which has fallen significantly, natural gas prices are now 80% below where they were in the latter part of August last year, and it's extraordinary how fast they've fallen, and that has benefited a lot of Eurozone states such as Germany and Italy, which were quite dependent on Russian gas. And actually, here in the UK, I'm not quite as pessimistic about what will happen here in the UK. I certainly think our inflation rate, which is going to be reported later this later this week, I think it's possible that it could fall further than what the consensus is suggesting at 10.5%. So yeah, expectations and optimism often optimism tends to not trounce to succeed more in the short term than expectations and reality over the coming year. That's what the market is, just optimistic for now. Okay, have the risks changed? I I don't think they have. I think the feeling from market participants that the global situation is not as dire as perhaps they were thinking in certainly in late November, early December. And I think things have improved a little bit. Inflation has fallen in the Eurozone more than expected, and it's fallen right back in the US to 6.5%, as we've just discussed. Um, but I don't think the risks have changed. I think the Federal Reserve has said that they want to stop inflation. They want core inflation to come down. Core inflation is the one that's more difficult to get back in the bottle. Core inflation is the one that excludes food and energy. Core inflation is the one that is normally hard baked into the system and is as a result of the headline inflation pushing people's expectation about inflation generally, which leads to core inflation as workers demand more pay rises, um, etc. And it sort of feeds on itself, and you can get a bit of a spiral of inflationary pressures. That's something that where those risks I don't think have really been removed. So I don't think the risks have changed much. I just think there's been a re-rating of the markets. They were a little bit too bearish, perhaps. They're less so now. But it's early days. It's just 2 weeks into the new year. Thanks for listening and watching.